Hello traders, Gary Wagner here. It is approximately 10:30 in Honolulu, the 10th day of October 2012. It is Wednesday, and this is the daily report for gold and silver. Unchanged to lower prices in gold this morning, higher prices in silver. First, let's take a look at gold. As you can see, this is basis the continuous contract of COMEX gold, currently trading 1764 and change, puts it down about 70 to 80 cents on the day. When we take a look at the cash market of gold, as you can see, 1762.63, as I said, putting it down about 70 to $1. The low has been 56.10, 1756.10, and the high has been 1769.30. In silver, we do have higher prices this morning. As you can see, we are currently back above $34 per ounce, a little bit. Current print on the screen, 34.06. The low has been 33.61 with a high of 34.25 on the day. Traders, I wanted to start today's show by talking about a special update that I put out yesterday recommending that we tighten our stops to put them tight below 1760. I also want to qualify what I mean by tight, and when I say below, exactly what kind of scaling you should look at. Of course, risk tolerance is different for everyone, and that's why I'll say below or at. Typically, when I say below, I'm looking at anywhere between 0.5% and 1% below the actual number that I'm talking about. So that if the market is trading, for example, at $1,000, 1% would be $10, 0.5% would be $5. When I say tight, I'm really talking about $5 to $6 below, a little bit less than 0.5%. Now, the main thing that I want to talk about is what I'm noticing in the market and why I actually put that out. Realize that when the market dropped back last week, we saw it hit an intraday low of about 1735. And this is a 360-minute chart. We can certainly see that here. Market stays kind of straight, and you can see this drop right in here. Drops, as I said, right around 1735 in that area. Now, following that, of course, what we noticed was the market came back up, and we had a tremendous rally as it went back up and tried to take 1800 out. Now, when we compress the chart, you'll see, and you're well aware of the fact that that is a real triple top at this point, because as we pointed out yesterday, there have been other occasions where the market simply couldn't take it out. We have our first, our second, and now our third really triple top in the marketplace. The fact that it couldn't take that out lends me to believe that there is a distinct possibility that rather than seeing consolidation in the market, what we might in fact be seeing is a correction that is still in play. Now, what really threw me off on this, if I misread the charts by any means, and the jury's still out because we'll have to see whether this market corrects and continues to correct, or it is consolidating, is the fact that following the market's drop to that 35, that 1635, we had a $32 gain the following day. That was showing me some incredible strength in the market. And typically when you see something like that, what you're witnessing is a marketplace where as soon as it's brought down heavily, buyers enter into the market. They believe that the value is there, and so they begin to scoop it up, and that won't normally propel the market. But the fact is, it should have propelled it to new highs and been able to close above this point, 1800, and not only close above this point, but have that become support. We, of course, didn't see that. Now, there's another way to look at this, and that is going to be, of course, through a weekly chart. Let me go ahead and pull that up. And as you can see, I've gone ahead and pulled up our weekly chart. This, of course, is in Henkin format, simply meaning Japanese average. So it's absolutely going to be a lagging chart. And this is what we can see when we look at it through the eyes of the average chart. And that is, there is no doubt, we're still solid green in the marketplace. However, at the same time, when you look at these last couple of weeks in terms of the trading activity and the body size, you notice a couple of things. First of all, we have wicks have resumed. the body size has been gradually shrinking. And when I say shrinking, I'm really comparing the body size that we're looking at when we consider how it was trading during the spurt of the rally right in here. And when we compare that to the body size that we're seeing here, you can see that it's displaying the typical activity that we would see in a market that is consolidating, also a market that is correcting. And the fact that it is consolidating or correcting, and that's what we'll have to determine, or the market will determine it itself, right at this critical point. You know that we talked for weeks about the fact that 1800, should the market be able to rise to 1800, we're going to absolutely see some sort of a fight as it gets there, because this, on a technical basis, strategically it's a landmark. I call it a century mark, 1800, 1700, and so forth, but it's a very, very strategic mark to be able to close there and above, because when you consider once the market finds support and is trading at 1800 plus, the next real level for it to go to has got to be the record tops, 1920. Because if you look at the market when it genuinely got to that point, you can see it was pretty much a straight rally all the way up. It was pretty much a parabolic rise. Good news for gold bulls. Bad news is parabolic fall at the same time. Now, traders, there's no doubt silver is reacting differently. And if you recall from my trade alert that I sent out last night, I did recommend that we really don't move our stops whatsoever in silver. We're long at $29, of course, and our stops currently are sitting at 33.20, just below. Again, below, simply use the 0.5% to 1%, and I would stick with about 0.5% or a little bit less. The intraday low that we saw was around 33.24, I believe. And so you can see that not only has... Now, silver has been a lot more resilient. There's absolutely no doubt about it. It has been moving up nicely. And more importantly than that, we have been long since about $29 on this trade. If you recall from the trade alert I sent out last night, it recommends that we simply hold our stop where it is. That's below 33.20 with an intraday low in the cash market at 33.24. So we were able to miss that by literally a couple of very, very small ticks. We're still long in that market. And the other thing that we're noticing, short-term Henkin chart 420, but take a look at the activity of recent on our Henkin chart. You can see we've gone back to green. We've lost the lower wick. Of course, body size is still small, but in any kind of a rally, typically you will get a building of size. Not always. Take a look at it right in here, or take a look at it right in here. You get kind of just a huge jump, a leap. But a lot of times you'll get the market where you've had the market in a downtrend, the body size begins to get smaller, you can see, and then it will go to green. However, you've had this consolidation. Of course, you can see that. You've had some lows right in here. I believe these are the lows that are going to take us into the mid and low $33 range. But absolutely, we're green again. We're going to have to see what this market wants to do. There's no doubt. We've got a lot of fundamental news out there right now that could move the market either way. The key right now is that initially on our gold trade, I was under the assumption that we were going to get a small consolidation in the market and a spurt to the upside. We, in fact, did not get that. For that reason, I felt that the low stop that we had in the market, when I looked at risk, compared it with reward, and compared it with the way the market was reacting, I didn't feel as strong about that trade as I did when we originally put it on. Now, also, that was coming off of a trade that we made $114 for traders who took that call. You would have put just, what did I say, a third to a half of your equity in there, meaning you have a very small position. That position is something we'll look to either add to later, or we might just simply offset that if this market stops us out. It came very close. As I said, we're very tight under 1760. The low, I believe, was 56. You should have that at least at 54 or 55, meaning you're putting it about a 0.5% below. 0.5% is $6 to $8 in the market. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Thursday for another daily update and review. Bye-bye.